by from the NYC is Thrivent CFO and CIO David Royal, along with HB Wealth Chief Market Strategist Gina Martin-Adams here in studio. Gina, let me start with you. Do you buy into the January effect, the technicals, or do you just really want to focus on the fundamentals for the year?
I think you want to focus on a combination. I don't know that I would lean on the January effect specifically, Taylor, but I do think that momentum begets momentum. So typically when you have a stronger momentum market, that momentum persists up until the point where it gets so overbought that we inevitably have to have a little bit of a corrective process. And we are in a period of very, very strong momentum right now. So the technicals are supportive of the market. Even if January is not a particularly robust month, the technicals are supportive. I like an environment in which technicals and fundamentals are supportive, and as long as earnings momentum is improving, as long as valuations haven't gotten so excessive for the entire market that you can't find pockets of optimism, fundamentals are generally pretty supportive at this time as well.
David, how are you thinking about January momentum, fundamentals, the setup for the year?
Well, the January effect seems to come earlier every year, but I think the fundamentals still remain pretty strong. We're going to have a couple live Fed meetings come here in the first half of the year.
Gina, come back to me when you were talking about you still like pockets where there are moments of opportunity.
Yeah.
Where are those pockets?
Yeah, I think we're seeing a little bit of that play out today in the markets. You talked about the leaders, and the first thing I thought is, wow, not a Mag 7 stock among the leadership today. And I think that that's a big part of the story of 2026 is we probably see a bit of a catch-up trade emerge, where tech has already lost a little bit of momentum over the end of last year. We really started to question the efficacy of the AI trade. We started to question whether or not we really wanted to pay 27 times earnings for tech stocks at large in the S&P 500. At the same time, you see signs of cyclical life potentially emerging in the economy. You see the Fed easing, and that's created a bit of a rotation. That means maybe down cap in the S&P 500. It maybe means a little bit of cyclicals as opposed to tech specifically. It also may mean mid caps, finally. We really haven't spent a lot of time talking about mid caps, which have performed reasonably well and could start to experience a bit of momentum lift in this kind of landscape.
I want to get into that, but David, how are you thinking? Because a lot of people thought, well, if the Mag 7 is almost 40% of the S&P 500, we really need them to pull up the rest of the market. Do you buy into that the way we have in the previous years, or do you like to see some of the underperformers start to give us a little catch-up trade here?
I think I agree with Gina in meaningful ways. Mid caps are the next large caps. But, in the small cap space, we've seen them behave a little differently recently than they have in recent years, where you kind of needed a rip-roaring economy for small caps to rally. They're behaving in a very interest rate sensitive way. So I think if we see some Fed rate cuts, that could boost small caps. They're more highly leveraged and they tend to borrow at shorter term rates.
David, though, bear with me, because I was speaking a couple hours ago with a friend, David Bahnsen, over at the Bahnsen Group, and he said, well, Taylor, be careful what you wish for, because if you get lower rates, that means the Fed's cutting and there's a slowing economy. If you are in a high GDP environment, the 10-year yield should rise to reflect higher growth. So which is it? Do stocks want lower rates or do they want higher rates?
I think stocks want lower rates. I think we are seeing some signs of slowing in the economy. Employment's been weaker. The most recent report had us at about 20,000 jobs a month on a rolling 3-month average. That's not strong. So I think if we avoid a recession, we get rates coming down, that actually could be beneficial for small and mid caps.
Gina, your thoughts on that rate story?
Yeah, I would just add to that stocks love lower rates on the short end as long as the long end is going higher and not higher too quickly.
Okay.
As long as the long end is going higher and not higher because of concerns about inflation coming, then it's a very conducive environment for risk taking. And that indeed is the environment that we've been in for much of 2025, is the yield curve becoming more upward sloping, anticipated Fed easing, helping the short end go lower, while the long end sort of stayed stable and even moved up a touch at times. It was definitely attainable for the market. It created a landscape of risk taking. So I think it matters what rates you're talking about. Of course, the market loves when the Fed is easing, as long as recession is not imminent. But the long end can be problematic depending on the rate at which it moves higher and what the reason for that rate moving higher is.
Final question to both of you, Gina. I'll start with you first. Biggest risk that we like kind of that black swan, that biggest risk that we're not yet prepared for, that has the ability to maybe take some of the air out of this market?
Yeah, I think the biggest risk, frankly, right now is just expectations. Everybody's expecting everything. We're priced for the Fed to ease, but also growth to resume. It's almost like we're priced for this perfect condition. And that creates risk in and of itself. We've started to see a little bit of dismantling of those expectations, as I mentioned, in tech. I'd like to see continued consolidation there to really allow the tech companies to grow into these enormous multiples. And we need to see cyclical recovery emerge in the economy. We've been in this very odd recovery since 2020. It's been a recovery that really has failed to achieve liftoff in the economy. So can we achieve liftoff in 2026? If we can, we have a very different market landscape emerging.
David, quickly, your biggest risk this year?
I think there's risk to both sides of the Fed's dual mandate. We're seeing weakening employment. Inflation's still stubborn at around 2.9% core PCE. So that's going to mean we're going to have some uncertainty around the next few Fed meetings.
David Royal, Gina Martin Adams, really appreciate having you both of you here today. Thank you so much.